Hello, this is Donald Mitchell. It's time for another Finance Magic Presents video snippets from Less Pain, More Gain, 10 Strategies to Pay Off Your Mortgage Faster, plus other smart tactics. We are on topic number 2, lending rule changes. This is video snippet 2A, an overview. Change is normal in the lending industry. We are in the midst of the most sweeping changes I have ever witnessed. If you obtained a mortgage loan in the past, the rules and procedures are different today. The most dramatic changes involve the appraisal procedure and the good faith estimate. The appraisal ordering process. In the past, loan officers ordered their own appraisals. Appraisers complained of too much pressure because loan officers could threaten to take their business elsewhere if the appraisals didn't come in at the value needed. Now the lender who funds the loan must order the appraisal, and the loan officer or real estate agent is limited in their contact with the appraiser. Lenders must set up third-party intermediary appraisal coordinating companies to order the appraisals. One side effect of the new system is that appraisals take longer to get completed. Another side effect is that mortgage brokers have to shop their funding lender before the appraisal will be ordered, because to switch lenders later will usually involve ordering a new appraisal through the new funding lender. A third side effect is that appraisers have less pressure to stretch the appraised value to meet the sales price. The new good faith estimate. HUD is trying to change the flow of how mortgage applications work with the new good faith estimate rules. Before exploring the new rules, we need to understand the old rules. The GFE form has been a foundation disclosure for the mortgage industry for a long time. It is exactly what the name says, a good faith estimate by the loan officer of the loan fees and other closing costs. Real estate agents have learned over the years that it is wise to have a prospect obtain a lender's pre-approval prior to showing them property. Why waste your time if they can't get a loan once you found them the property? The old GFE was a one-page form. It estimates the total cash needed to close, and the applicant signs the form. As we look at the form closer, at the top is a spot for the loan amount, interest rate, and term of the loan, and then the fees are itemized in sections. The 800 section at the top is for the lender-based fees. Then there's sections for the title fees, the government recording and transfer charges, and any other additional settlement fees before you get the total of the estimated closing costs, which is the same as the non-recurring closing costs if you listen to the Finance Magic booklet snippet. Below that are the prepaids, split into two sections: items required by the lender to be paid in advance and reserves deposited with the lender. These are totaled, and then the non-recurring closing costs and the prepaids are totaled into the total estimated settlement charges. The final item at the bottom of the old good faith estimate is the total estimated funds needed to close. They start with a purchase price and subtract the loan amount to calculate the down payment, and then adjust the other fees to get the total needed to close. On the right-hand side, they list the monthly payment. The old GFE had no real accountability. Loan officers could bait and switch the borrower all day long without getting caught, because the old GFE was meaningless until you locked in the interest rate. The temptation for loan officers was to quote the wholesale price of money plus a low markup at initial contact, because that was when the borrowers did their interest rate shopping, and then adjust the markup at rate lock time to make sure the loan officer's commission was in line with expectations. Usually the wholesale rate will either go up or down between the initial contact and the rate lock time, so the markup adjustment kind of got lost in the shuffle. The old GFE had to be provided within 3 days of completing a loan application, even though the borrower was just trying to get pre-qualified to know how much property they could afford. These were known as TBD applications because the property address was listed as to be determined. If a loan officer pulled a bait and switch at interest rate lock time, it was usually too late for a borrower to do anything about it. The new GFE is a 3-page form. It does not calculate the cash required to close, and there's nowhere on it where you have a signature. The new GFE adds loan officer accountability through a system of tolerances that the lender must adhere to or risk losing their license. There is zero tolerance on the section involving the loan officer markup, so they must close the loan with a markup equal or less than the markup priced into the new GFE when it was first issued. The new rule encourages borrowers to shop between lenders now that borrowers can receive honest quotes. To accomplish their objectives, HUD has redefined the definition of a loan application. Traditionally, the loan application form was labeled a 1003 that the loan officer filled out to take a loan application. The 1003 form is still in use, but that is not considered to be the application. The new definition of a loan application involves the receipt by the loan officer of the 6 pieces of information listed below. The critical item is number 6 in this list, the property address. There is no application until we have the property address. When we have all 6 items, we have a loan application, and the clock starts ticking to deliver a new GFE within 3 days. Once the new GFE is provided, the borrower is encouraged to shop for a better rate from other lenders by providing the 6 items and collecting multiple GFEs for comparison. None of the lenders are supposed to ask for additional information or collect any funds from the borrower except for the credit report fee until the borrower selects a lender in writing. The loan officer's fee portion of the rate quote is guaranteed for 10 business days minimum from the issuance of the GFE, and if selected by the borrower, the fee portion must be honored within tolerances through the close of escrow. This does not mean that the interest rate can't change between the issuance of the GFE and the rate lock time, but the loan officer's markup can't change. The goal is to stop the bait and switch. These new procedures lengthen the time it takes to close escrow. If you ask multiple loan officers to provide new GFEs, they must do significant work to provide a GFE that they must stand behind, and only the loan officer the borrower selects will get paid. The only upfront fee that can be collected by the loan officer is to pay for the credit report. The new GFE rules prohibit providing a GFE prior to having all 6 elements that comprise the loan application, and if a loan officer jumps the gun, it is presumed they were provided with the information and they can't justify making changes if they obtain the correct information later. GFEs can be altered if there is a changed circumstance, but only if the corrected GFE is provided within 3 days of the loan officer receiving the changed information. There is no guidance for pre-GFE behavior, so each lender must devise their own pre-qualification procedures, except they are barred from providing a GFE before they have a property address. This means loan officers can complete a 1003 application and provide a total cost to close estimate and collect pay stubs, tax returns, bank statements, etc., and seek a TBD credit-only pre-approval before the formal application. At the point in time the borrower has accepted an offer on the property, HUD encourages the borrower to obtain GFEs from multiple loan officers in search of the best rate. This concludes Video Snippet 2A, an overview of the lending rule changes. Tomorrow's snippet will be focused on the new GFE form. Thank you for listening.